Silver is sending a message that the broader market may not be fully understanding yet. The metal has pushed back into the mid-60s, and on August 14th, it was trading around $64 an ounce, still roughly 68% above its level a year earlier. That is not a normal move for a market that is supposed to be driven by industrial demand alone. And the timing is even more interesting because the latest US inflation data is actually giving the Federal Reserve more room to stay patient. The July Producer Price Index was unchanged from June, while producer prices were up 4.7% from a year earlier, down from 5.5% in June. Final demand goods prices fell 0.7%, while services prices increased 0.2%. In other words, the immediate inflation pressure at the producer level is cooling, but silver is not cooling with it. That is the first thing investors need to understand. If silver were rising only because markets expected a new inflation shock, a softer PPI report should have taken some fuel away from the rally. Instead, silver remains elevated. That tells us there may be more than one force operating underneath this market, and this is where the gold story becomes important. The source material behind Jim Rickards' $10,000 gold argument makes a very aggressive distinction between two different forces. His thesis is that gold's earlier advance was driven primarily by geopolitical and financial system concerns, while a future demand wave could come from a broader loss of confidence in the purchasing power of money. Whether that $10,000 target ultimately proves correct is not the point yet. The important point is the mechanism, because if monetary concerns intensify while inflation expectations begin rising again, gold could receive a second source of demand, and silver could be pulled into that move from two directions at the same time: monetary demand on one side and industrial demand on the other. That combination is what makes silver different. Gold is primarily a monetary metal. Silver is both monetary and industrial. It is used across electronics, electrical applications, solar technology, and other industrial processes. So when investors become more concerned about currencies or financial stability, silver can attract investment demand. But when manufacturing and technology demand remains strong, the industrial side can continue providing another layer of support. That creates a much more complicated market than simply saying inflation is up, therefore silver goes up. And right now, the inflation picture is mixed. The July PPI data looks considerably cooler than the previous month. The official data shows that energy prices fell sharply, with final demand energy down 3.1% in July, while gasoline prices fell 5.7%. That helped keep headline producer inflation under control. But the same report also shows that not every pressure has disappeared. Core measures remain elevated, and prices for final demand, excluding food, energy, and trade services, increased 0.4% during July. So the market is not looking at a clean victory over inflation. It is looking at a temporary cooling in some components while other price pressures remain. And that distinction matters enormously for precious metals. Because the biggest mistake investors can make right now is to look at one inflation number and assume the entire macro environment has changed. It has not. The Fed still has to balance inflation against economic growth and the labor market. Softer producer inflation reduces the immediate pressure for tighter policy, but it does not automatically create a new bull market in silver. Something else has to happen. That something could be a change in real yields, a weaker dollar, stronger investment flows, renewed geopolitical risk, or another acceleration in physical demand. And this is where silver becomes particularly interesting. The metal has already shown that it can move violently when several of these forces appear together. After reaching an all-time high around $121.64 earlier in 2026, silver experienced a huge correction before recovering back toward the $60. That tells us something important. This is not a one-way market. Silver can rise dramatically, but it can also correct dramatically. So the real question isn't whether silver can go higher. The real question is what force is powerful enough to keep silver above this new price regime once the initial excitement fades. Because if the answer is simply speculation, the rally can break. But if the answer is monetary demand plus industrial demand plus constrained supply, then the market could be entering a completely different phase. And that is exactly where the Rickards thesis becomes relevant. His argument is that the biggest monetary driver of gold may still be ahead rather than behind. If that argument begins to play out, silver would not be watching from the sidelines. It could become one of the most aggressive expressions of that same macro trade. But before we make that conclusion, we need to examine the pressure building underneath the physical market and why silver's industrial character could become its biggest advantage. That is where the next part gets much more interesting. Now, look at the part of the silver story that the headline price does not fully explain: the physical market. Silver is not simply a financial asset that moves because traders change their expectations about the Federal Reserve. It is also a metal that has to be mined, refined, transported, and ultimately consumed. That physical reality becomes much more important when prices rise this quickly. As of August 14th, silver was around $64 an ounce, still roughly 68% above its level a year earlier. The move has been extraordinary, but what makes it more interesting is that silver has been able to remain near these elevated levels even after short-term profit-taking. On August 13th, spot silver fell about 1.2% to $64.51, while COMEX silver settled at $64.873. That tells us something important. Buyers have not disappeared simply because the metal is expensive. But there is a second side to this market. High prices eventually create their own resistance. Industrial users have to deal with higher input costs. Manufacturers may try to reduce the amount of silver used in individual products, substitute other materials where technically possible, or delay purchases. Investors who bought much lower may decide to take profits. And traders who see a market that has risen more than 70% in a year naturally become nervous about a correction. So silver is now fighting two opposing forces. On one side, there is strong monetary and investment interest. On the other, there is the possibility that extremely high prices begin changing industrial behavior. That is why the next phase could be much more volatile than the first phase. And this is where silver's dual identity becomes critical. The latest market data describes silver as both an investment asset and an industrial metal, with applications ranging from electronics and solar panels to medical technologies. That means the same economic slowdown that might eventually reduce some industrial demand could simultaneously increase the appeal of precious metals if investors become concerned about growth, currencies, or financial stability. In other words, silver can receive conflicting signals from the same economy. A weaker economy can be bearish for industrial demand. But a weaker economy can also become bullish for silver if it produces lower rates, a weaker dollar, or renewed demand for monetary assets. That is why watching silver through only one lens is dangerous. Now bring the Federal Reserve back into the equation. The July PPI report showed final demand producer prices unchanged from June, with services prices rising 0.2% and goods prices falling 0.7%. Over the year, final demand producer prices were up 4.7%. The report reduced the immediate pressure for another aggressive rate move, and Treasury yields also moved lower after the inflation data. For silver, that matters because lower yields can reduce the opportunity cost of holding a non-yielding asset. But there is an even more interesting connection. Citi analysts recently argued that silver could benefit from recovering investment demand, a less hawkish Federal Reserve, and eventual easing of tensions around the Strait of Hormuz. Their published scenario put silver as high as $95 an ounce next year, while also assigning a 20% probability to a decline toward $50. Notice what that tells us. Even bullish analysts are not describing a straight line higher. They are describing a market with enormous upside potential and enormous downside volatility. That distinction is crucial because if silver reaches $70, $80, or eventually $95, investors may look backward and assume the entire move was inevitable. It wasn't. At every stage, the market has to absorb profit-taking, changing Fed expectations, shifts in the dollar, industrial demand, and physical supply. And this is exactly why the gold thesis we discussed in Part 1 matters. The source material argues that gold could eventually receive a much larger inflation-driven demand wave if supply shocks become embedded in consumer expectations. If that happens, silver could benefit from the same monetary psychology, but with an additional industrial component. That could create a powerful feedback loop. Higher gold prices attract attention to precious metals. Higher gold prices make silver look relatively cheaper to some investors. Silver then attracts additional investment flows. At the same time, industrial users still need the metal, and because silver is a smaller market than gold, relatively modest changes in investment demand can produce disproportionately large price movements. That is the part many investors underestimate. Silver does not need every major economic indicator to become bullish. It needs enough forces to become bullish simultaneously. Right now, we have a softer inflation signal, reduced expectations for immediate Fed tightening, silver still trading near multi-year highs, and a market that remains extremely sensitive to geopolitical and physical supply developments. But there is still one major question. What happens if the macro environment changes from a story about cooling inflation to a story about renewed supply pressure? Because that is where oil, shipping, and geopolitical risk come back into the picture. And if that happens while silver is already sitting around $64, the next move could be determined less by what happens to inflation today and more by what investors believe inflation will look like 6 months from now. That is the setup we need to examine next. Now, we get to the part of the story that could determine whether silver's move toward the mid-60s is simply a powerful rally or the beginning of another major repricing. The market is currently receiving two messages at the same time. The first is that U.S. inflation pressure has cooled enough to reduce the immediate probability of another Federal Reserve rate hike. July producer prices were unchanged month over month, while the annual PPI rate slowed to 4.7% from 5.5% in June. The second message is that silver remains extraordinarily strong, even after a modest pullback. On August 14th, silver was around $64 an ounce, still up roughly 68% from a year earlier. That combination is telling us something. The silver market is not waiting for today's inflation number to become tomorrow's inflation story. It is looking further ahead, and that is exactly where supply shocks become important. The Rickards material argues that there is a difference between temporary supply-driven inflation and the more dangerous situation in which consumers begin expecting prices to keep rising. His argument is that once people change their behavior because they expect higher prices tomorrow, inflation can become self-reinforcing. We should treat that as a thesis rather than a fact. But the mechanism is important. Imagine energy prices rise sharply, transportation becomes more expensive, manufacturers face higher costs, food becomes more expensive. Businesses eventually have to decide whether to absorb those costs or pass them to consumers. At first, consumers may simply cut spending. But if the market starts believing that prices will continue rising, behavior can change. People buy earlier, businesses rebuild inventories sooner, workers demand higher wages, companies raise prices to protect margins. Suddenly, the market is no longer reacting to one supply shock. It is reacting to expectations. And precious metals become particularly sensitive to that transition because investors start asking a different question. Not, is inflation high today? But, will the purchasing power of money be lower tomorrow? That is a much bigger question for gold. And it can become an even more explosive question for silver. Because silver has something gold does not have to the same degree: industrial demand. If economic activity remains strong enough, manufacturers continue needing silver. If monetary uncertainty rises, investors may want silver as a precious metal. The two sources of demand can therefore overlap. That does not mean silver automatically goes higher. In fact, it creates a major risk. If the economy slows sharply, industrial demand can weaken. If the dollar strengthens significantly, dollar-denominated commodities can face pressure. And if real yields rise, investors may become less interested in non-yielding assets. That is why today's softer inflation data matters. It gives the Fed more room to remain patient, and markets have reduced expectations for an immediate September hike. Reuters reported that the probability of a September increase had fallen to around 35% after the latest inflation and labor market data. Lower rate hike expectations can support precious metals, but there is a strange contradiction here. If inflation continues cooling, silver may benefit from easier monetary expectations. If inflation starts accelerating again because of supply pressures, silver may benefit from inflation hedging demand. So either direction can potentially create support, but for completely different reasons. That is why the next several months could be so important. And there is another factor that cannot be ignored: oil. On August 13th, Brent crude settled around $87 a barrel and U.S. crude around $81 after oil prices had fallen more than 2% that day. The market remains sensitive to developments around the Strait of Hormuz and the broader U.S.-Iran situation. For silver investors, oil is not just another commodity to watch. Oil is an inflation transmission mechanism. Higher energy costs can feed into transportation, manufacturing, and production costs. Lower energy prices can do the opposite. So if oil remains contained, the inflation argument becomes harder to sustain. But if another major supply disruption pushes energy prices sharply higher, the market could quickly start revisiting the inflation question. And that is where the silver trade could become much more volatile, because silver is already elevated. A market trading around $64 does not need much new buying to move dramatically, but it also does not need much selling to produce a sharp correction. Citi analysts recently outlined exactly that two-sided risk. They projected silver could potentially reach $95 an ounce in 2027, while also assigning a 20% probability to a decline toward $50. That is not a prediction of a straight-line move. It is a warning about the size of the opportunity and the size of the risk. And this is where I think the market needs to stop asking whether silver is expensive. The better question is, what would have to happen for $64 silver to become cheap? If monetary conditions become easier, investment demand can increase. If geopolitical uncertainty rises, safe haven demand can increase. If industrial demand remains resilient, physical consumption can remain supportive. And if supply becomes constrained at the same time, the market has a recipe for another major repricing. But there is one missing piece: gold, because silver rarely operates completely independently of gold. When gold begins making a major monetary move, silver often gets pulled into the same precious metals trade, but with greater volatility. And the Rickards thesis is built around exactly that possibility, that the biggest monetary demand phase for gold may still be ahead. If that happens, silver could become the higher beta expression of the same macro story. But there is a catch. Before silver can make another explosive move, it has to prove that this current $60+ price zone is not simply a temporary speculative peak. And that test is already beginning, where we examine the levels, the gold-silver relationship, and the scenario that could take silver from a strong rally into a genuine macro breakout. Now, we get to the level that matters most for silver. Not simply how high the metal can go, but whether the current price structure can survive another round of volatility. Silver has already shown just how violent this market can become. Earlier this year, the metal traded above $100 before suffering a major correction, and Reuters noted that silver was hit harder than gold, partly because of its industrial character and the much larger rally that preceded the decline. That history matters because it tells us something very important about the current rally. A move from the 60s toward $70 is not automatically confirmation of a new permanent bull market. The market needs to prove that buyers are willing to defend higher prices after the excitement fades. On August 13th, COMEX silver settled at $64.873, down about 1%, while the Reuters spot quote was around $64.88. That is not necessarily bearish. In fact, after such a powerful advance, a controlled pullback can be healthier than another vertical spike. What matters is what happens next. If silver can absorb profit-taking while remaining above the low 60s, the market begins building a different kind of structure. Instead of traders simply chasing momentum, long-term buyers start treating lower prices as opportunities, and that changes the psychology of the market. The next major psychological barrier is $70. That number is important because round numbers attract attention from traders, institutions, and the financial media. But the more important issue is what happens around that level. If silver approaches $70 and immediately gets rejected, it would show that sellers are still willing to defend the upper range. If silver breaks through $70 and holds above it, however, the conversation changes. The market would begin looking back toward the previous highs and asking whether the January-type surge can happen again. And there is another metric that could give us an even better signal: the gold-to-silver relationship. This ratio tells us how many ounces of silver are required to buy 1 ounce of gold. When the ratio falls, silver is outperforming gold. When it rises, gold is outperforming silver. Reuters pointed out earlier this year that the gold-silver ratio had moved above its 200-day moving average during silver's previous weakness, with 70 identified as an important psychological level for the ratio. That gives us a useful framework. If gold begins accelerating while silver fails to participate, the ratio could rise and silver could remain the weaker metal. But if silver starts outperforming gold again, the ratio would fall. And that would be a much stronger signal that the market is rotating towards silver rather than simply buying precious metals broadly. This distinction becomes especially important when we return to the latest macro data. The Federal Reserve is facing a strange environment. July producer prices were unchanged, U.S. consumer inflation rose 0.1% month over month, and markets reduced the probability of a September rate hike. Reuters reported that the implied probability had fallen to around 35%. That is potentially supportive for precious metals. Lower rate expectations can put downward pressure on yields and reduce the opportunity cost of holding assets that do not pay interest. But there is another side to the equation. Gold itself has already reacted strongly to this shift. Reuters reported that gold climbed to a 2-month high before profit-taking pushed it lower, with central bank buying and broader uncertainty continuing to support the metal. If gold continues higher from here, silver will have a major test. Does silver simply follow, or does it outperform? That is the key question. Because if gold begins another major monetary move and silver remains stuck around the same levels, the silver thesis becomes weaker. But if gold rises and silver rises faster, the market would be telling us that investors are increasingly looking for the higher beta precious metal trade. That is where the upside becomes much more interesting. Imagine the sequence. Gold breaks higher because investors become more concerned about monetary credibility, geopolitical uncertainty, or real yields. Silver follows because investors want exposure to precious metals. Then industrial demand remains resilient. Then speculative capital notices that silver has historically produced larger percentage moves than gold. That can create a feedback loop. It does not guarantee a rally, but it explains why silver can move much faster once momentum becomes established. And there is another factor working in the background: supply. Silver supply cannot instantly respond to a sudden increase in demand. New mines require years of development, and much of the world's silver production comes as a byproduct of mining for other metals. That means higher silver prices do not necessarily create an immediate flood of new primary silver production. So when investment demand rises quickly, the market can become much more sensitive to available inventories. And this is why the physical side of the story matters so much. The price on a screen can move in seconds. The supply chain cannot, and that mismatch is one of the reasons silver can become extremely volatile when investment demand suddenly accelerates. But there is a warning here. A bullish thesis can be completely destroyed by a combination of a stronger dollar, rising real yields, weakening industrial demand, and aggressive profit-taking. That is why I would not describe $70 as a guaranteed destination. I would describe it as a test. Above $70, the market gets another signal. Below the low 60s, the breakout thesis becomes much less convincing. And somewhere between those levels, the battle between buyers and sellers will tell us whether this is a sustainable repricing or simply another powerful silver spike. The biggest clue may ultimately come from gold. Because if the Rickards thesis about a much larger monetary repricing begins to gain traction, silver could become one of the fastest moving parts of the entire precious metals complex. And that brings us to the final question. If silver survives the current correction, gold continues attracting monetary demand, and the Fed moves closer to easing rather than tightening, how far can this move realistically go? That is where we need to separate the bullish scenario from the bearish one and identify the levels that would actually change the story. Now we can bring the entire story together. Silver is sitting around $64 an ounce on August 14th after briefly trading above $66 earlier in the week. It is still roughly 68% higher than a year ago, even after pulling back from its recent highs. That is an extraordinary gain, but the most important question is no longer whether silver has already had a huge move. The question is whether the forces behind that move are strong enough to support the next one. And right now, there are two very different scenarios. In the bullish scenario, the Federal Reserve becomes less restrictive as inflation and labor market conditions give policymakers more room to ease. July PPI was flat month over month, while the annual increase slowed to 4.7% from 5.5% in June. Markets consequently reduced expectations for a September rate hike. If that develops into a broader decline in real yields and a softer dollar, precious metals could receive another wave of investment demand, then add gold. The Rickards thesis we examined argues that gold's major monetary repricing could still be ahead. The source describes the possibility of a future inflation-driven phase following the geopolitical and financial system concerns that have already supported gold. If gold begins another sustained advance, silver has the potential to respond with greater volatility. That is because silver is a smaller market and has an additional industrial component. But the bullish case does not require everything